So we're going to kick off this conversation with a two-sided question. First, I would like everybody, when they're giving their answers, to introduce themselves and give us a quick overview of the funds they represent. The first part of the question is, what's your investment thesis for thinking about the mobility and logistics space? So what view of the future are you investing against, or are you trying to make a reality? The second side of the question is, mobility has recently become really popular. What's your theory why? Why do you think lots of attention and capital are now pouring into the space? You can pick any one of those or answer both. We can start with you, Dr. J.
Morning. So TLcom is a TechVC company. We have the Tide Fund, which has been deployed now, is a third fund, and it's basically an Africa-focused, so sub-Saharan Africa-focused fund. Our investment thesis is really around mobile-enabled technology. Anywhere where mobile or mobile platforms can either disrupt, innovate, streamline, or create value, that's where our interest is. So that makes it very, very broad indeed. We're sector agnostic, so it's health, education, mobility, finance, whatever it is. And we tend to invest between $500,000 and $10 million. In terms of the second question, which is what is making urban mobility so popular, I think it really is because of what is happening in most of our urban cities across the continent, where we are getting a lot of rural-urban migration, and so therefore transportation becomes a major, major issue. We don't have the infrastructure that we have in other parts of the world in terms of, public infrastructure, buses, taxis, whatever it is. And so there's got to be some innovation around how you move, in a city like Lagos, how you move, 5, 10 million people across this city every single day. And it's not only people, it's about goods and services. So really that's why it's becoming so interesting. As the cities grow, as there's more urban-rural migration, and there's a need to actually begin to manage the costs around mobility as well.
Thank you very much. Taiwo?
Okay. Oops. Sorry. So my name is Taiwo. I work with EchoVC, and essentially we're a tech and tech-enabled focused venture capital firm. We have investments across, we're stage agnostic, but we have 3 funds. So from our first fund, we do a lot of early stage investments, small size checks from as low as 50K to as high as 250, 500, $1 million. And then we also have a partnership with TPG on their Rise and Growth Fund as their small check platform for investments from about $1 million and above, $3 million actually, 5 million, 3 million and above. Our investment thesis is really focused around anything that organizes the offline. So, as long as it's Africa and Africa focused, we know that Africa is not that developed in the sense that tech can just be driven on its own. So there's always that human component of having to physically organize certain things. So as long as your product organizes the offline, that's what our thesis is around. Why is there such a buzz now around mobility? I think particularly for Nigeria and Africa, I think population is one of the factors that contributes to this. And then we also have a lot of, poor income earners, a lot of poor people, and that's why there are so many Okada, Boda hailing companies. I know in the past, I wouldn't want to get an Okada because I just felt it was largely unsafe. But when you live in a city that is ridden and plagued with traffic and you're trying to get somewhere fast, the easiest and fastest thing to go on, it will be a motorbike, as opposed to sitting in an Uber or a Taxify now called Bolt. It also is driven by, I think I already talked about income earning potential. So a lot of people are poor. Africa is like one of the most populous cities or continents, and also a lot of migration, like Mr. Bola mentioned, from rural areas into urban cities, and a lot of traffic jams. So that way, as long as people have to move themselves and also their goods, there'll always still be that buzz around it because it's solving certain hassles for different people.
Thank you.
Good afternoon. My name is Nnena Nkongho, and I am here on behalf of Digital Growth Africa, or DiGAME. We invest out of a permanent capital vehicle in Africa's tech-enabled growth businesses. We believe in the power of technology to fundamentally alter the lives of Africans. I can't think of a single business or segment that hasn't been changed by the application of technology. And we look to back great founders and founding teams who are transforming life. I think, like the other two panelists, we're excited about mobility. We're excited because it's a sector that not only has attracted a lot of capital globally, but it's intuitively obvious that both the trends around population growth and increased urbanization will lead to increased demand for goods and the movement of goods and services. And it's really the intersection of both the application of technology to systems that are by and large broken, but really we're investing in the opportunity that this presents for investee companies to find workarounds, but really build the type of modern, sustainable infrastructure that will support further economic development. That easy.
Thank you all for those responses. One common theme that I pick up on is that you're focused on, one of the things that you're looking out for is the kinds of businesses that stitch the online world and the offline world, especially across Africa. That comes with unique costs or unique issues. So can you speak to some of the unique challenges of investing in these kinds of technology businesses? So to give an example, if you are formalizing the two-wheeled mobility space, one thing you will have to account for is that there is regulation, or there's existing organizations who have interests to protect. A Google or a Facebook may not necessarily have to deal with some of those things, but building businesses that move atoms around, not necessarily just bits, create some of these, or exposes some of these challenges. Can you speak to some of the ones you've seen? I think, Nnena, you can start.
Okay, sounds great. I think, so I'd like to start off by saying yes. To build big businesses, you ideally are looking at bigger markets, and focusing on what we call, mass markets intuitively means that we are looking for businesses that address a different level of familiarity, sophistication, data consumption here in Africa than we would find in the West. And we have tended to see is that businesses that straddle that digital and physical divide tend to do it better than ones that solely focus on the digital. And also because usually it's the physical that's really hard. And that's really the problem that you're trying to apply technology to make it better. And so that's why we tend to favor businesses that do that. It's not that we would exclude a business that was sort of focused on the tech layer only, but we'd really have to see what the implications were in terms of adoption, et cetera, et cetera. I think that mobility is particularly suited to this because it is about either the physical movement of people or goods, and that has an operational component. You can't simply move stuff just on an app. The goods actually, or the person actually has to go from A to B. So, from that perspective, that's why.
If I might add to what Nnena has spoken about, I think for me, challenges of investments in this space, already there's, the existing infrastructure is quite poor. For haulage, if you speak to a typical truck owner, they're always complaining, the roads are bad, going in and out, you have area boys stopping you, blah, 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 all sorts, bribery, hijacking. So there's already there are already existing inefficiencies, right? And when you involve or introduce tech on that layer, it really favors the educated to go online and, order a truck or order a car. But we also have a let's say, illiterate population, right? So you're dealing with that. What else? Again, because you're trying to really solve the physical components of these things, as long as, government is not putting policies and working through improving existing infrastructure, education, all those things would eventually still affect your investments, right? So you really just hope and pray that things get better, the government is more forward-thinking, there's more interaction between the private and public sectors to, share pain points and how the government largely has to do a lot to also address these things that the private sector cannot address alone. So those challenges, yeah, they will always be there.
Thank you very much. Dr. J?
I mean, the only thing I would add to that is basically that you are trying to disrupt fairly entrenched business models when you're looking at the physical and the digital world. And if you take the example, you can take both examples, whether it's the bike taxis or haulage, where with the long distance haulage, they're very, very entrenched players in that space. People that own trucks, that own them for many, many years, and really there's a way that business is done. And you come in as a usurper trying to change these business models and create platforms that really, as far as they're concerned, they don't need. So there's a lot of work that goes into the acceptability of these platforms, the literacy of the drivers and all of that. Even if you take the bike taxis as well, most cities around the continent, there's a very entrenched business model. There are people that own these bike taxis who have no interest in actually joining these platforms. So that's the challenge that you find. And in truth, it's a very interesting question you ask, because most of the investments that we will make in this environment are those that actually have the physical and the digital world. No matter what you look at, finance, health, it's all about trying to figure out how you bring those two worlds together. And so the one challenge I would say that most founders have, and it's a VC's problem because you want founders to solve it, but it's really around how do you get the people that are in that physical model, the entrenched model, to begin to buy into the digital model. And the second thing that you also need to think about is really around the particularly when you compare Nigeria to Kenya, where the technology literacy in Nigeria is actually much lower than it is in Kenya. So the speed and the level of adoption of some of these platforms is actually much slower. And the final thing is around regulation. These are industries that are very highly regulated, badly or well, and you've got to deal with that as well. That regardless of whether you have a platform and it's you've got no assets, you don't have bikes, you don't have trucks, you are still affected by the regulation. And you've got to figure out how you work around the regulation or work with the regulators to make your business model more effective.
My immediate reaction to that is, I just remembered, there's a trope often propagated by people who don't work in the tech industry that code will not solve the most important problems. It's often that code or software will not solve the most important problems. It's often used to poke fun at the naive optimism of technologists that they can build software, and quote unquote save the world. And so listening to that, I'm wondering, the entrepreneurs that you are seeing in the field, are they looking to, quote unquote, disrupt existing business models, or are they taking a partnership-first approach? And which of those do you think is more compelling? Taiwo, do you want to start?
I'm thinking. So you said it's either they disrupt or what? Or partnership?
The classic technology story is that you have a young, often inexperienced, green-eyed tech entrepreneur who will build software or change the incentives in an industry for their economic benefit and for the benefit of the world, again, against entrenched interests. And the first part of my question is, the entrepreneurs that you're engaging with, are they primarily are they going against existing players, or are they looking to incorporate them or cut them into the deal? And which of those do you personally find more compelling?
Well, it could be a mixture of both. But I think most of the founders are seeing, I mean, they're very optimistic, and I really can't downplay optimism and its importance. But what would pay in an environment where there are existing models, I think, would be to get a buy-in, first, understand how this works, and then, boom, disrupt, right? If you come from the approach of, I'm just going to come into your space and scatter it, these guys are strong as well, right? They have those relationships that your coding and your softwares cannot solve. So my mom would say things like, you stoop to conquer. So you stoop, act dumb, get in, understand, and then take what you've learned and disrupt that space. That's how I would say they approach it.
Dr. J?
I think our own approach is more, we're less interested in the technology, even though we're a tech VC fund, because we make the assumption that the technology is going to work. So, software development, all of that, we just make that assumption. And what we then look at is, how does your business model, what is your understanding of the industry that you're trying to disrupt? Very, very important. And how does your business model actually disrupt that industry? If you understand who the players are, where exactly am I disrupting or adding value to the value chain, if I can put it like that? So it's a great point in the sense that, yes, software isn't everything, but software is at the core of everything that you do, but it's how you then build your business around that software. So when you look at if you take the bike taxis, for instance, where we say that, yes, there's this great platform where you can call a bike. But, the first question I asked when I was talking to some of these bike taxi companies was, but these bikes are just going about. So why do we need to get an app to call a bike when I can just say, and the bike appears, And so you find that their models, they begin to sort of innovate within the realities that they have. So like Damla said, you can come in with this idea that you're going to get in there and disrupt, but it's not quite like that. You have the app, but then you allow alternatives, and you begin to attract people onto this platform, and you ensure that the platform is sticky enough that people actually stay on the platform. Because some of the challenges you have is, for instance, when we're looking at Swivel in Cairo, where it's basically buses. People will, you're incentivizing them to come on the buses. So you say, for every ride, you get a free ride. And of course, once they get the free ride, they're not coming back again. But you've got to figure out, how do I get them to have that free ride and come back again? So it's looking at the physical world, but also making sure that you're bringing them into that digital world, and you're making them stay in the digital world as well.
Nnena?
So I agree with the points made by both my panelists. I would also add that every founder has vision, right, and is brave in a way to start something that most people don't think makes complete, is aligned with the current version of the world. So we accept that and we celebrate that. But I think what we also like to do is to, very similar to what Omobola said, is to understand how the founder has created or is creating a business model, and sort of, if they can identify the stakeholders in whatever ecosystem they are, and understand what the value is that they're creating. And I think also, let's not forget that early stage businesses change their strategies, so that what we're looking for is a team that's self-aware. They may choose one approach and then realize that something isn't working and change it. So we're looking for teams that use data and use the information around them and around their customers to sort of reflect the best approach that will gain the most traction and build a bigger, more valuable business.
One of the things I'm hearing is the use of technology as a Trojan horse, to speak to Taiwo's comment. And to speak to Dr. J's comment, she said TLcom tends to assume that the technology will work. I think that's an interesting idea we should get into a bit. If you compare player by player, the technology I haven't seen technology being used as a differentiating element. So you can reasonably assume that when I open the Uber app, for example, the app will work to a certain degree, and I will see cars available or whatever else. You can reasonably assume that for most of the players. And technology in some ways is table stakes. As a consumer of the bike taxi startups or their products, it's not clear to me that there's any room for differentiation player by player or for them to meaningfully improve the user experience. And that often leads to situations where capital is being used as competitive advantage. So the most important thing to anybody who's hailing a ride, for example, is that there is a driver ready to take them from point A to point B, close by. And so it seems to me like the most important factor in any of these industries is getting to scale, which requires loads of capital. Given that your capital is finite, how do you think about funding the kinds of businesses where a player with more capital could come in and basically ruin your economics, as we've seen happen even with Uber in China, in Russia, in Southeast Asia? Dr. J, do you want to start?
So you're right. Look, capital is unlike other parts of the world where VCs operate, where there's the billions of dollars of capital. The capital here is actually quite scarce. So you want to be sure that the capital is being properly deployed for any company that you invest in. And I think you're right when you say that there is the technology, well, it's not to de-emphasize the importance of the technology. I think it's absolutely important. I said it is the core of the business. And so, yes, you need to spend capital developing the technology, making it easy to use. Because again, with these urban mobility you're talking about, the average user is not a very sophisticated user. So you need to make it very easy to use, 2 or 3 clicks and you've done what you want to do. And so that's where the design and the skills of the product engineers and software engineers comes in. But in truth, when we look at how we deploy capital, what we're really more interested in is how you're going to 2 things. Your business model. And specifically talking about urban mobility, how does your business model address things like getting drivers or the drivers, either the long-haul truck drivers or the taxi or the bike taxi driver? How do you get them on the platform and stay on the platform? How do you incentivize them? How do you train them? What do you do to make sure they stick to the platform? That's the first thing that we look at, and that's a non-tech business model. Second thing we look at is that when they're on the platforms, how do you ensure that they stay? Because you get a lot of driver churn on these platforms. The drivers will come, they'll do one ride, and they go back and start doing their normal Okada rides again. How do you get them to stay on the platform? That is a critical success factor for any urban mobility. Whether it's an Uber or Lyft or whatever it is how do you get these drivers to come to the platform and stay on the platform? And those are the kind of KPIs we look at, and those are the kind of things we look at in the business model. So yes, capital is important, but I think what is more important is where that capital is deployed. And finally, I think what is critically important that many founders don't think about, and just to go back to your point around scale, and this is kind of my consulting background kicking in, when you want to scale a business, you've got to have everything, processes, system, technology, standardized. They tend to think about the technology only from the app or the software that they're using for the business, but ensuring that you have a robust organization that can scale as you do. And because we see that many times where the market is huge, the company can scale, but it just can't scale because you don't have the right talent and you don't have the right processes. So that's also an important way to actually deploy that technology to ensure that when your company starts to scale in the market, you as a business can actually grow with the scaling of the market.
So I would agree with you largely, but I think that at least, I don't know, let's call it in the past 6 months, especially in mobility, I think there's a market perception at least that with these larger raises, they're more visible, they're more public, that the ability to raise capital, is a strategic advantage, versus somebody who is, let's call it, less well capitalized. And I think it provides you opportunities in terms of thinking about adaptations to the business model. So I think you're correct in that, things like customer retention are that's fundamental. Do you have a business model that is sustainable and scalable? But I think that capital is also an ingredient, because I think, as you pointed out, we haven't, as venture capitalists, really funded a business through a full cycle like an Uber. So, Yeah, the jury's still out, right? The jury's still out. So I would say that's sort of my, at least, initial perception. But I do think that, we are all encouraged, and that's why we're all here. So.
Taiwo?
Okay. So I do think capital is an advantage to these founders. But I think besides capital as an advantage for your business, and I mean, I kind of touched on earlier in the little group, I would also be looking at how efficient is your business model. Do you have standard operating procedures? Do you have the right team to drive, this physical components of the business? Because it's not solely just tech-driven or just automatic, really. It's not just plug and play, right? So how efficient is your business? What sort of processes are you putting in place to, curb down leakages or inefficiencies, right? And most times when founders come and, this person raised something millions, I'm like, focus on your business, right? Like, understand it, master it, right? Do what you can with the little that you have. Because besides just getting capital, a lot of this business is just born through it on subsidies because, really, those are your customer acquisition costs. You're trying to bring people to the platform. But like Dr. J said, how do you make them stay? Most times my friends might open an app when they see, come on this app and get 2 more trips free. And then they take you 2 trips and the app is sending you a message in another 5 months. Oh, we've missed you. Take this again. Come on board, right? You're just burning through without even thinking about how efficient is your model as a business, right? So I think those are the things that, any founder or any company should also think about, and then having the right people in these businesses to help you drive, operations and hopefully, move towards profitability as opposed to just being focused solely on revenue and your numbers and how many rides you do.
So, quick reminder to please ask your questions via Slido. Go to slido.com and use the hashtag TCMobility to ask your questions. I want to put Dr. J on the spot a bit. You made an investment in Kobo 360. It's my belief today, and please correct me if I'm wrong, that part of Kobo's value proposition to drivers is helping them fix a cash flow problem when some of the larger organizations, I think it's T60, but yeah, they take a while to pay, and that often affects, the driver's operations. That means, though, that as Kobo scales, and I guess this applies to all the companies in that sector, as they become more successful, because of the peculiarities of the business model, they are then taking on that working capital risk. How do you think about a world in which success is detrimental to a company you funded?
So yes, there's a huge amount of finance that's required. I remember at the last Kobo board meeting, we sort of stood there asking ourselves, is this a logistics company or is it a finance company? Because it's part of that, your business model to attract drivers onto the platform. And, one of the things that Kobo does to attract the drivers is to prepay them for the trips. So it's easier if you say, do this trip, I'll pay 70%. When you deliver, I'll pay the balance of 30%. What Kobo has done and I think Obi was here earlier on, without revealing any secrets, is that they found a way to actually get that capital, but not have to take the risks themselves. So that capital is not coming from the money that we funded them. They've partnered with, again, the partnership collaboration, partnered with banks and other financial institutions to get money to the driver, still continue that prepaid a trip, but not having to take the risk themselves, because it's too big a risk for the company to take on its own.
Interesting. And then do you have thoughts?
No. Saying good.
Not time yet. So, final question from me is about liquidity. So, one of the premises of the venture capital business is the ability to invest upfront in product development and then reap outsized returns because the marginal cost of delivering each service, or one unit of each service, is low to zero. Investing in things that interface with the physical world, that's not quite true. So each marginal advertiser or user of Facebook is effectively free, and Facebook's investors, if they were still a private company, would be earning a return. For physical businesses, Uber incurs a significant cost to facilitate each trip, and I believe that's true for all the businesses you've invested in. Especially in that world, how do you get enough of a valuation jump at the stage you're investing to satisfy your investors, especially in markets, or in these African markets where we don't have where our capital markets are not as deep? Anybody want to go first?
Okay. Essentially, all I really hear you kind of talk about is exit, right? As an investor, yes, I know we are looking for returns, right? And, you're already trying to just forecast at what X multiple would you exit or whatever. But I would say that sometimes you have a shift in thinking in the sense that hopefully my investments in the business will, working together with the founders as well, really will just be to drive the growth of the business, like just drive growth as much as possible without actually just focusing on, is it 1x or is it 2x or 3x? So I know, yes, especially in Nigeria, our capital markets are not really what they should be, and you find a lot of people IPOing in maybe New York Stock Exchange or NASDAQ or alternative markets or what have you. But if you focus on driving your business to grow into such bigger businesses, the exit opportunities would be either to, if you want to, exit in a follow-up round, or you could also go IPO, right? But I still see businesses here having the ability to focus more on driving their growth in their business, and you could even raise much more down the line. Like, for me, I don't just really see this whole capital play. If you just focus on what is really, why are you in the business, right? Are you just trying to exit to a strategic, or what exactly is driving it? But like I mentioned, just drive your business growth. And for exit opportunities or liquidity opportunities for we as investors, we either be an IPO or exiting to another investor further down the line.
Nnena?
So I'd answer your question a little differently. I think you're right. It means that businesses scale differently here. And I think that that's the challenge. And that's also why African early stage investors, venture investors like us, are even more focused on the economics and scalability of business models earlier on, is because, a business that is in the physical, isn't going to scale the same way or with the same economics that a purely digital one would. I think the second point I'd make to address your question is that we're still early. This is an early ecosystem in terms of early stage investing, and so we all believe, that's why we're here, that we will get the venture type returns that our LPs, our clients require. But, we don't have, 50 years of history that sort of shows us that this is what we're getting. But I think that means that compared to our global peers, we are more focused on sustainable business models earlier in the cycle, and the costs to scale. That would be my response.
Dr. J?
I would just add one thing, which is to say that we have actually exited two companies in Africa. And the way that there were two paths to exit. One of them was upstream, and we exited to Actis, so you exit to PE firms. The other one was a company called Movirtu, and we exited to BlackBerry, who actually bought the technology that Movirtu had. So it was relevant. Movirtu was using it as a virtual SIM for people that can't afford a phone in Africa. You can actually have a virtual SIM and use somebody's phone and your virtual SIM. But for BlackBerry, although they're kind of not here anymore, but for BlackBerry, what they were looking at was the technology. So you could actually have 2 SIM cards in a BlackBerry phone. So the exit opportunities are there. But like Nnena said, it's still early. And again, just to buttress down Nola's point, the focus, yes, of course, but at the point of investment, you look at exit paths and exit opportunities. But once you make the investment, it's all about working with the founders to build and scale that company. But just to make the point that, whenever they say, sure, but there's no exit, there's no liquidity, we say, well, actually, we did 2 exits in Africa. And as we get more companies and there's more interest in Africa, in tech and in tech in Africa, I think that those paths to exit will come, whether through PE firms, IPOs, strategic buyers like a BlackBerry, they will come.
My immediate reaction to that, is for the businesses that we're investing in to be, valuable enough, they must get to a certain scale. It's not clear to me yet that businesses can get to that scale within one market.
Yeah.
Therefore, we see us treating Africa as a single market. So a company that's only operational, for example, in Lagos is doing X for Africa. But you see that the way the companies form from the ground up, they're often organized around conditions specific to some of those markets. And so a payments business that starts in Nigeria, for example, expanding to Kenya does not meet the same landscape. And in the same way, especially for the kinds of businesses that interface with the physical world, the landscapes are often very, very different. And so how do you think about investing in the kinds of companies that are, that might get to a certain scale great in one market, but those physical things introduce new costs for them to get to the scale where you can exit to a strategic who's not thinking about Nigeria, they're thinking about Africa. Any order?
I guess I would say there are 2 things. I think one is that you assume that they're going to need to be material, I say tweaks, but that the business model needs to be adapted if you are going to expand into multiple markets. Or you create a different type of, or you project a different type of return scenario for that type of business. I don't, it's all about sort of price relative sort of scale. It changes your estimation of the addressable market. There are a lot of great Nigerian businesses that struggle to leave Lagos, right? Let alone, expand into other metropolitan areas, whether it's Accra or Nairobi. And you are right, a business that, is built and developed here isn't necessarily going to succeed in Nairobi. I think the observation I would make is that many businesses that start in smaller markets much earlier in their growth trajectory think about multiple market expansion than Nigerian businesses, simply because, again, I'm going to repeat it, a lot of Nigerian businesses are struggling to get out of Lagos. So that would be my observation.
What I would add to that is that the need for expansion also does an additional thing, particularly when you're looking at exit. It creates that diversity and that risk management for you. Because when you look at Africa as a whole, you have 54 countries, but each one of them has its own risk. And if you look at a company that is only in Nigeria, what if Nigeria explodes or whatever it is? If you're in Nigeria, Kenya, Egypt, at least you have some level of risk management. So that's why it's important for many of the companies that we have, tech companies, to actually think about that expansion, even though they don't need to. There are many companies, depending on the sector. We're talking to one company now where truly because of the size of the Nigerian market, it's a consumer business. It can do 2-3 million consumers in Nigeria alone. And that is scale. So you ask him, when are you going to go to X? And he says, why? I don't need to. And you've got to agree with him. But up to the point where if you're going to try and do an exit, you've got to diversify the risk in your business by actually going to another country and replicating this. Not easy, as you say, because regulations, markets, competition is very, very different as you begin to expand outside your home country.
Taiwo, any thoughts?
I would just add that, different parts of Africa work differently. In East Africa, for instance, there's a large, mobile penetration. They are more open to mobile money as opposed to here in let's say West Africa or Nigeria. So, like she said, you may have a business here and you're making millions of naira or dollars that you wouldn't even make in an East African market or a North African market, just because the different culture, different language, different perception, way of life is different. The things that tick their fancy is different, right? It also depends on the business model. So you can scale being in one country, but if it's a product that's, will I say, cuts across different climates, yes, it's just a way of diversifying your risk, and I guess just opening deeper revenue streams to grow faster. Yeah.
Thank you very much. We will now go to the questions asked by Slido. The first one is, in mobility startups, what are your key lookouts for investing? What measure do you apply for valuation, and do you invest in ideas or already run startups? I believe the answer to that question is clear, but does anyone want to speak to it?
Well, for us at EchoVC, we don't invest in ideas. Preferably, we would like to invest in revenue-generating businesses. What will I look out for in investments? I mean, I think it's also on our website. So generally, we'll center around 5 T's. So be the team, traction, the technology, your moat, and what else, actually? I've forgotten the last one. I know we have 5. Tosin, please help me out. Yeah, I can't remember, but those 4, basically, those are the key things I would look out for if I was going to invest in any mobility startup.
Next question, what is the process for a startup to apply for funding at your fund, and what stages of companies do you fund? Half of that question has been answered. Second one, visit the website. Some African cities have a public transportation crisis. Will your investment focus be based solely on returns or on ideas that can solve, e.g., congestion problems?
Returns. But in truth, look, if it's a good company, you are solving the problem anyway, and you're solving the problem in a way that results in a significant commercial return. Because we don't believe in impact in Africa. Because if you look at it really well, if you're solving a grand challenge in mobility, in health, whatever it is, there is going to be impact. So we're looking at really commercial returns.
So I would say that, and I would say that what any entrepreneurs in the audience or people who are wondering, each of us, has a job to do from our investors. And so we invest in traction in terms of most of us are not necessarily investing at the idea phase of things. So that if somebody has something, an initiative off the ground, it has some commercial viability through use, that's something that gets VCs and investors excited. I think each of us has, in terms of how much money do we give, each of us, has amounts that we will invest. So I think, Taiwo, you said as early as 50,000 from one platform up to millions, I think you said 2 to 10, like me, 2 to 10. So, businesses that get that type, we're minority investors generally, so businesses have to be of a certain size before that type of investment is possible.
One final question. How concerned are you about government regulatory impact on your businesses? What possibilities worry you?
Not so much on our business, but our portfolio companies. I mean, there is a big concern because when I look at all the companies we've invested in, most of them are in reasonably regulated aspects. And there was a quote somewhere, which I believe that the biggest risk to any company operating in Nigeria or an emerging market is regulatory risk, because the regulators don't think the way that we do. They can just one regulation basically could just pull the carpet from under you and your business is gone. I think the industry that is probably the most vulnerable to regulation now is the fintechs, because basically it's regulation around licensing, which is big, because if you get a license cost that is 3 or 4 times what your current cost is. You just imagine you raise $5 million and overnight the regulator says, well, the payment license is now $2 million. And so basically half your money is gone overnight, and you've got to figure out how to then continue on your path to growth without having to go through a process of raising again. So we worry about that. And really, when we look at companies that we invest in, we look at how strictly regulated the industry in which they're operating is in. And if it's really highly regulated, we tend to just shy away. How much of it is dependent on government and government regulation and policy and all of that. So we tend to shy away from those kind of companies because, as a past policymaker, I understand. I understand what government does. Sometimes it doesn't make sense. Many times it doesn't make sense, but to give a run in a business. But, it happens, and so you've got to be aware of that.
Taiwo?
+1.
And with that, I'd like to thank my panelists for taking the time to speak to us today, and thank you for listening.